Hi everyone, welcome to Market Outlook, trends, risk events, and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I just let you have a look at the disclaimer, um, I'll just run through what we hope to get through in the next 30 minutes or so. I should start off by saying if you do have any questions, I always say this, but please do ask them along the way, whatever you're looking at, whatever we're talking about, setups, fundamentals, technicals, whatever. Please do ask any questions, and I'll try and answer those. Otherwise, the disclaimer's here. And yes, what we'll try and get through in the next 30 minutes, we'll just follow the standard format. So we'll just check out how markets are trading currently. Pretty busy time, actually, with a lot of headlines at the moment, of course. Um, we'll have a look at earnings season, which is upon us now. Q4 US earnings season, really, with big banks reporting this week. So we'll look at that. Then we'll look at US stocks or the indices, actually, and just technicals around those. And then we'll look at, last week's main events, which was, of course, the non-farm payroll report, the US jobs report. We'll look at that in some detail and just some implications for that. Other bits of data out of the US as well last week, and then some CPI data out of Australia and also the Canada job. So we'll look at Aussie dollar, Canadian dollar as well. And then we'll look at this week's main events. Not too busy really on the calendar front. So we do have US inflation data on Tuesday, retail sales on Wednesday, actually. And that's pretty much it. Some UK GDP data. So we'll look at cable as well. So sterling against the dollar. Lots of other news, as I say, in the headlines already this year with Venezuela, of course, but then this weekend as well. If we just move on from the disclaimer, here's what we'll hope to get through, as I say, pretty much summing up what I've just talked about. If we go to, well, markets currently, it's been a sell America theme, if you like, this morning, really, although it has pulled back slightly. So we've had a selling of the dollar. We've had stock market futures, at least in the US, looking quite red, down 0.6% and more for the Nasdaq. And then we did have US Treasuries as well involved in that sell-off. But then this has slightly paused just for the minute. If you can just bear with me 1 second, as I have just a technical issue to deal with. Just bear with me. Apologies, small technical issue there. So, yeah, Salamanca theme really, dollar selling off, stock market selling off, US stocks, futures are down. And then we had treasuries as well involved, a little bit of a pullback really, and we'll get into that shortly. Um, all really on the overnight news about Fed Chair Powell basically potentially being indicted by essentially President Trump. And he's come out with a pretty strong response. I want to get into this straight away, actually, because there's a few things around US news which are of interest. This being obviously the first one front and center. Powell has basically said that the US Central Bank was served with grand jury subpoenas related to Powell's testimony and renovations, of course, of the Fed headquarters. However, Powell clearly indicated that the move should be seen in the broader context of the administration's threats and ongoing pressure, basically, to monetary policy. Very, very forceful reaction from him. And it really marks quite a clear escalation in the fight on central bank independency. Grabbing a lot of headlines, of course, and it is the first time in I think in 112 years that this has kind of happened, blown up. And certainly then that market reaction, pretty understandable. As I said, Treasuries, US Treasuries, they added 3.5 basis points initially. So futures are down, dollars up, down as well, and gold has hit all-time highs. Various factors with that as well, with the Iranian situation. But in currencies, dollar down, and then the Swiss franc, interestingly, outperforming safe haven currency, of course. The yen normally would have appreciated as well, but that has other issues because of a potential snap election by the new Prime Minister Takaichi, newish Prime Minister at least. And there is then political uncertainty in Japan. So that sort of hit the yen slightly. For us, then going forward, really, it's the bond market which will be the most important barometer. So, both on the short end of the curve, really, so that sort of 2 year yields, US Treasury, really, which correlates much more strongly with the Fed moves really and interest rate cuts. So the short end of the curve will be something to look at if markets basically price in more rate cuts, or then in the long end, so that sort of 10, 30 year plus, if that shows potential stress signs basically on independence risks. So, and then potentially, and I don't want to get into this too much, but then if we see a sharp sort of steepening of the curve, 2 year yields lower, much lower, 30-year yields much higher, that could then hit the dollar quite forcefully. Yeah, really interesting period. This obviously we've had questions around Fed independence before, and that has hit the dollar quite strongly in the few weeks afterwards. So we're really watching this quite closely and what happens next. It will be highly debated, of course, on sort of financial news wires that we all look at really. But of course, these are still sort of headlines at the moment. So just be wary of that as well. Sort of drawing sort of firm directional conclusions is not. Well, it is based on these current headlines so far, which are troubling. But of course, we just need to monitor it going forward. Along with this, of course, there are other geopolitical risk events as well. US reaction on the tensions in Iran is interesting, and really probably why gold has pushed higher. Oil was higher, though it pulled back actually, was pulled back through the morning. We also have the pending ruling of the US Supreme Court on tariffs potentially this week. Um, and then we also then have the potential announcement of the Fed, the new Fed chair, after Powell leaves in May. So a lot of sort of non-data releases really that are potentially impacting markets, but obviously this Fed independence one is critical. Just on that as well, I should say we had last week or over the last week, really, since the new year has kicked off, President Trump as well. Um, really sort of embarking on different policies aside from the Fed, away from the Fed to try and impact the cost of living. This, we think, will be really quite a big theme heading into midterm elections, of course, not till November, but really he's trying to impact the cost of living. And of course, all with an eye on those elections in November, as I say. So, for example, he's been demanding now credit card companies to cap interest rates at 10%. That's drastically down, really, from the 20% plus we've seen in recent years. Lenders argue that such rates really are to compensate for the lack of collateral when borrowers default. Evidently, really, and warn that the rates cap could result in reduced credit availability. President Trump, he set a deadline of January 20 for companies to comply, adding that they would be in violation of the law, I think he said, if they didn't. So interesting move there. He also has, well, this follows instructions last week for government-sponsored enterprises, Fannie Mae and Freddie Mac, to purchase $200 billion in mortgage bonds. And this, simply put, really is aimed at driving down mortgage rates. So aside from what the Fed does, if they don't cut rates, of course, not as much as he would like, certainly. and even potentially not at all for the next few months. And we'll get into that with the non-farm payroll report. But then he's trying other policies to, as I say, push down borrowing rates really for to try and alleviate costs for most of the population in the US. As I say, all ahead of the November midterms, and really quite a quite something really in this sort of new policy agenda that potentially President Trump is driving through. Moving away from that, then it is, of course, earnings season. Let me just pull up a chart first of all. Which is this one. So expectations for Q4 earnings season and full year actually results as well. Expectations should show a continued but moderating growth of annual earnings to rise 8.3% year on year. That is the dotted line there, overall growth. That figure would mark the 10th consecutive quarter of growth for the benchmark, and revenues are seen up 7.6% year on year, which would not only mark the 21st consecutive quarter of growth, but also the second fastest pace since the third quarter of 2022. Generally, and it's since really COVID, I think that especially then, since then, analysts really have been quite conservative in their estimates, and that's why we get these consecutive beats in earnings. Regarding valuations, the S&P remains generally overvalued by traditional metrics, though again that has been the case for some time now, and in isolation is doesn't mean we should look at a different view. The index's 12-month forward PE ratio sits around 21.8, I think, which is above the 5 and 10-year averages, though below the 22.8 seen at the end of Q3 last year. Then on a sector level, expectations point to nine out of, and you can see this on this chart here. So 9 out of the 11 S&P sectors should chalk up annual earnings growth. Technology and materials lead the way, and then communication services and health are forecast to post solid revenue growth as well. You can see that here, with financials just below in amongst those as well. And then on the red side, on the negative side, consumer discretionary set to record the largest year-on-year earnings decline for some time. That's weighed down by big declines in autos and household durables, all likely really a reflection of consumers marginally pulling back on spending as the impact of slightly higher prices continues to be felt. We've also got industrials in the red as well. So those are the 2 of the 11 sectors expected to post earnings growth decline, essentially, whereas 9 sectors will post earnings, positive earnings. I'm just looking then at other expectations from a revenue perspective, slightly different. Growth is likely to be broad-based again. 10 of the 11 sectors seem reporting an annual increase. That's again led by tech. Only the energy space is set to report a year-on-year decline in revenues. This is largely resulting from the greater than 20% decline in crude prices that we've seen over the last 12 months. So yes, that's a broad outline of what is expected. As is usually the way, the major Wall Street banks, they kick off earnings this week, kick off the season generally. We begin with JP Morgan, the biggest bank in the US, releasing their results just before the open on Tuesday tomorrow. Then bank earnings generally looked at very closely, not only kind of as a barometer of broader economic performance and consumer spending, but also they kind of set the stage, if you like, for how the remainder of the reporting season may progress. Specifically then, credit provisions, they're likely to be watched particularly closely, with big banks essentially still very strong due to a number of factors, due to healthy M&A that we've seen, the broader robust economy, the regulatory environment remains favorable, and then we've also had stable credit quality and resilient net income. And it's really no surprise to see the banking index, the KBW banking index, into earnings season at a record high now. So that's earnings for financials and for the big banks expected this week. JP Morgan, as I say, we get those, that bank reporting tomorrow. We get Wells Fargo and Citigroup reporting before the market open on Wednesday, and then Goldman Sachs and Morgan Stanley, big investment banks, report are before the market open, I think, on Thursday, the 15th. So, yeah, a number of earnings to look out for straight away at the start of this season. One other big company that is reporting non-financial this week is TSMC. So Taiwan Semiconductor Manufacturing. They report on the 15th. And certainly this will be closely watched for signals basically of whether the AI investment boom has further to run. They are the world's number one producer of advanced chips, of course, and they certainly pushed global equities higher in October when it essentially raised its annual sales forecast and posted a massive beat on third quarter profit. It's already reported, just for your guide, estimate beating revenue for the fourth quarter. And it's a supplier to tech heavyweights like Apple and Nvidia, is expected to then post full year sales. This is what we're looking at, which climbed above 30%. That is according to LSEG. It does also come on the heels of Samsung Electronics projecting a threefold surge in quarterly operating profit amid tight supply for conventional memory chips. So one to look out for there as well on Thursday, as I say, TSMC. Watch for that, and then headlines then guiding US futures, essentially US stock futures. Okay, that's the earnings season pretty much. We will be sort of writing small previews of some of the big companies on our daily commentary, which is put out on the website after the US close. So watch out for that as well. Otherwise, as I say, global equities. Let me just pull up a couple of charts first up. Bear with me 1 second. Not too much to say about the US charts, to be fair, but I'm just pulling up. This is the S&P 500. Had a pretty strong day on Friday, actually, although we're probably going to give most of that back today. Looks like at the start of the day, at least. Strong day on Friday. Cyclicals outperforming defensives. Tech was once again not in the top performers really extending the pattern that we have seen since the start of the year. S&P rose 0.6%, Nasdaq 0.8, Russell 2000 0.8. That's the small cap index. Stock 600 rose, Eurostox that is, 1%. Materials clearly outperforming on Friday, rising 1.8%. And interesting, actually, year to date, that Russell 2000 small cap index, a very strong start, up almost 5%, and that's well above the 1.5% rise in the S&P 500. Asian markets, they were in the green this morning, interestingly enough, obviously with everything going on. But obviously US futures now in the red, as I say. S&P 500, new high on Friday, 69.78. Was the high, and the close 69.66. Just looks like bullish consolidation. Although if we hit the futures chart, which is here, you can just see we're pulling back to around that previous high from October, which was at 69.53. Those are the futures, just for your guide. Nasdaq lagging, so not made new highs yet, and that new high is at 26,182. You can see there, found support around the 50-day moving average at 25,342, the blue line. but futures are pointing to prices 0.8% lower. So if we just pull up that futures chart, we're not dipping below the 50-day moving average there, but just sort of hanging around, not being able to break quite previous highs from sort of late December. Pull up the Dow as well. Futures showing, 0.7% lower on the open. You can just see new highs being made last week, up to 49,500, just above there, that close. Was it a new high on Friday? Intraday high? No, not quite. So the intraday high is at 49,621. We closed at 49,504, which wasn't quite a record high, actually. Record high last Tuesday at 49,509. But if we check out the futures, we're just pulling back, but it looks like bullish consolidation, sorry, unless we lose probably last week's low at 49,000 or so, and then potentially we move back down into this area here between 48 and 49,000, you would think. Okay, those are stocks. Let me just go then to last week's main events. First up, um, which is here, of course. So we had non-farm payrolls, US data as well in the ISMs, and Australian CPI. And I also mentioned Canada jobs as well at the same time as non-farm payroll. First up, non-farm payrolls then on Friday. Headline came in at 50,000 versus the 70,000 expected. And there were 76,000 of downward revisions to the prior 2 months. So November now 56,000 from 64,000, and October 173,000 negative from 105,000 negative. Yeah, we've got all the numbers in here. Remember, Fed Chair Powell, he suggested that officials believe the BLS, so the Bureau of Labor Statistics, who gather all this information, they are overestimating payrolls growth by around 60,000 per month. So essentially, that suggests pretty much the job market is stagnant. And looking over the past 6 months, non-farm payrolls has averaged just 14,500 now. So adjusting, if you like, for Chair Powell's assessment on the measurement error, this implies actually that the US is losing more than 45,000 jobs per month. So, somewhat stagnant, if not declining there. Better news, though, on the household survey, from the household survey, really, that's calculated to use the unemployment rate. That dipped to 4.4% from a downwardly revised 4.5%. That was originally reported at 4.6% last month. And then rounding out the numbers, wage growth, that came in at 0.3% month on month as expected, though the year on year was higher at 3.8%. From 3.6% in November. I've got the percentage there then. So before the numbers, we were sort of 1 in 5 chance, just below that, for a rate cut in January. Now, a very, very minimal chance of a rate cut now in January. 28th of January, I think, the Fed's meeting. And then is, I think, less than now a 50% chance of any kind of rate cuts before or up till when Fed Chair Powell leaves in May. Interesting with the detail of the jobs created, actually. I've talked about this before, but the composition is concentrated in private education and healthcare services. 41,000 of the 50,000 jobs added in December, that is. And over the 3-year period since January 2023 now, this sector accounted for 55% of the 5.2 million jobs added in the US economy. While government, 13,000, I think, in December, that contributed 20%, and leisure and hospitality, around 18% of all jobs, net jobs added. And all other sectors, so that's if you think of those big sectors like tech, construction, manufacturing, business services, financial services, transport and logistics, they only account for around 7% of the job creation during that period. So just really interesting detail about what jobs are being created, really not jobs that would historically drive a very strong, what would drive very strong growth in the economy. Um, and in December, just ending on this, really, that grouping actually lost, as I've just mentioned, all of those sectors. They lost 51,000 jobs actually, and has only seen actually one up month out of the past eight. So just interesting detail we think there, even though of course the economy continues to tick along really, but there are underneath, really under the hood, these details which are of interest and potentially will impact at some point. Um, it does, again, though, also reinforce the message about the Fed probably needing to offer a bit more support for the economy at some point going forward. As I say, not yet anything really priced in now, and it did pull back after this report as well, but just we're mindful of this detail going forward. Um, Of course, caveat to that should be that dip in the unemployment rate, and of course, as well, respectable wage growth. That does offer some mitigation, but the jobs market undoubtedly has cooled through last year. Um, and certainly with monetary policy still described as modestly restrictive, it does probably justify further gradual rate cuts. Obviously, we get CPI data this week, which we'll get into shortly. But there is little prospect of any move, of course, ahead of probably the March FOMC meeting at the earliest. Um, just a chart then on that headline number as well. You can see 55 was the original consensus estimate. That went up to 70,000 through the week. And we obviously got a print of 50,000, which gives you a guide really just compared to the previous headline prints. We also had other data, as I said, ISM data, quite important leading indicator. Manufacturing, that dropped below 48 in December. That marked the fourth consecutive monthly decline and actually the lowest level since October 2024. The backlog of orders also continued to shrink, suggesting kind of a risk of inventory buildup. And that could potentially be an employment hit in the months ahead. ISM services data that hit on the opposite side, really a 40-month high, really surging output, orders, and employment. But it does actually contradict the relative softness seen in other business surveys. Interesting data there, so a mixture of data. And we also got job opening numbers. They cooled more than anticipated. And that did sort of reinforce the theme, which is kind of called the low hire, low fire theme narrative, really, for the US jobs market, which sort of was pretty much reinforced by the NFP data as well. We've written about that low hire, low fire narrative, and that kind of sums up, yeah, exactly where the labor market is at the moment in the US. Okay, let's get on. I'll just pull up an Aussie dollar chart now, actually, when we get into the inflation data. Aussie is kind of a funny currency. I know that a lot of people have been very long, big banks are long, expecting this sort of range trade to break out, and we've not been able to break out of it really. RBA potentially hiking rates, and also contrasting quite strongly with other major central banks, amongst other things. For the CPI data, just for your guide, then last week. The headline was unchanged, with the annual figure falling somewhat more than hoped from 3.8% to 3.4%. Consensus estimate was 3.6. The biggest contributor was housing, and that was followed by food and non-alcoholic beverages, and then transport. The key measure, though, is the trimmed mean inflation gauge. That ignores essentially the most volatile price swings and is the RBA's preferred measure for core inflation. That showed prices rising 0.3% month on month, 3.2 year on year from 3.3%. Annual goods inflation that slowed mainly because of electricity prices. Services inflation that slowed as well due to domestic holiday travel. And it was interesting, really. And actually, what we said in our preview on the daily commentary that we put out, the lower inflation print really didn't alter the market's view really that much when we look at what's priced in for the RBA. Still really expected to raise rates by their May policy meeting. And a decent chance, about 1 in 3 of before that, I think, as well. Um, you can just see here then I'm just checking when the data. It was on Wednesday, yeah, the Aussie data. So we did spike higher, actually. You can see that to 67, 66. And then we just pulled back for 3 days. And then we're rising again, really, on the dollar weakness today. Um, yeah, interesting. We haven't really been able to break this minor fib level. We struggled there, you can see in September of last year, really, and then move lower. Again, we had that spike, as I've just said, to 67, 66, and we're just down below that minor fib level of last year's, well, no, the recent high from September 2024, actually, and then the April 2025 low. So the 76.8 retrace is at 67.21. But as I say, cap the upside previously, and then we're just struggling around it at the moment. If we can break that recent high, then obviously these highs probably, yeah, around here, 68 or so from back in 2024, July, and then September, with obviously that big long-term high at 69.42 in the Aussie. Moving on to Canadian data. Let's just put up dollar versus the CAD, and it's not that one, it's this one. Interesting rebound, really, of the dollar versus the CAD after moving lower over the previous sort of 6 weeks into year end. You can see we got down to 136.42 before then these consecutive days of gains of the dollar over CAD. For the jobs data, then we saw 8,200 new jobs created in December. That beat the estimate of negative 5,000, but that does come after 3 months of outsized gains. The economy essentially has added a total of 181,000 new jobs from September through November, in contrast to almost no change in the first 8 months of 2025. That's, of course, when US tariffs and trade uncertainty were really choking hiring. The unemployment rate that rose to 6.8% from 6.5 and above the expected 6.6% as more people essentially search for work. There were, I think, 1.55 million people unemployed in December. That's an increase of 72,900 or 4.9% from November. With more people looking for work than the unemployment rate suggests, there is plenty of slack remaining in the labour market in Canada. Bank of Canada, they held rates steady at 2.25% in December. Money markets really expect them to stay on hold for 2026. Although this data, well, it kind of backs it up, but potentially could be a possible cut if this data starts to continue sagging. Dollar CAD, then you can just see, as I said, rebound with dollar strength really through the end of last year and the start of this year. Of course, we've gone through the black line, the 200-day moving average. That's at 138.43, and we're just touching now the 50-day moving average. That's at 139.06. So interesting whether that is resistance or not, with support of the 200-day moving average. And then you have got these fib levels of the highs from November, and then this low at the end of December. Halfway point of that move at 138.84. No, 138. Yeah, 82. That's the halfway point of this move. Next fib level above that, 139.50, and below that is just below that 200-day moving average at 138.32. That's dollar CAD. Let's get into this week's main events then quickly. First up, of course, is US CPI data. And just a chart on that. Yeah, December inflation data forecast to show a headline print at 0.3% month on month, 2.7% year on year. Pretty much matches the previous reading. For the core, 0.3% month on month and 2.7% year on year. December pickup largely reflects basically the unwinding of distortions from those disruptions that we saw of data collection during the government's shutdown. They basically amplified seasonal discounting in November. Goods prices, they're expected to rebound more sharply than services, while the tariff sort of pass through, if you like, does appear to be moderating. So you remember months ago where everyone really was expecting tariffs to bump up prices. Haven't really seen that. Still waiting for them, still waiting for them. Going to happen, but at the moment, it doesn't seem to be happening too much. Services inflation, that should firm, though, notably in travel related categories. While on the flip side, shelter inflation, a big portion of the CPI basket, that is seen following its pre shutdown trend, which means lower prices and softness really in shelter. Health and motor vehicle prices as well, insurance prices actually, they are expected to restrain CPI as well in the coming months. So that's CPI. Just on this chart, you can see benchmark index, of course, and then core and headline still somewhat above that 2% Fed inflation target. For other measures of inflation, the New York Fed's monthly survey of consumer expectations that rose in December. Consumers expecting 3.4% price growth over the next year. That's up from 3.2 in November, while longer term expectations were steady. I did touch upon ISM data. Just interestingly, manufacturing prices, they remained in expansion, matching November, while services prices, they fell to actually their lowest levels since March of last year, though it still has exceeded for 60, sorry, for 13 straight months. So that's CPI data. We do get retail sales on Wednesday as well. Consensus expects both the headline and control group to rise 0.4%. Holiday item spending was strong in October and November, but by all accounts slowed around Black Friday and then Cyber Monday, probably because consumers were shopping earlier for deals. We talked about the K-shaped economy, really, and that's probably going to be summed up with retail sales figures being fairly solid, really, and positive at least. K-shaped economy, just for your guide again, that is still playing out. So that's really, if you think of the K, then the top sort of arrow, if you like, or the 45-degree angle higher, that's the top 20% of households, basically by income, who continue to spend strongly, boosted by decent incomes and soaring wealth from stock markets. But then the other 45-degree part of the K moving lower, that's the bottom 60%, still struggling on concerns about job security and again potential tariff induced price hikes. So yeah, quite like that idea. It's been going around for some time now, but just to reinforce that with you guys as well. Let's pull up the DXY chart just quickly. So just bear with me 1 second. Which is here. So interesting point, really. DXY. Dollar index, of course, maps the dollar against 6 of its biggest trading partners. So we've got the 50-day and 200-day moving average. The 50 days a blue line, that's at 99.06. Black line at 98.82. Blue line crossed above the black line, so that's a golden cross, so should be bullish. But sometimes this is lagging, and obviously then we've had this decent rebound from below 98 at the end of last year. So Potentially that is the move already. Resistance then at the 50-day, possibly as well the 200-day. So 99.06, 98.82. Interesting zone of support resistance here. Then above there, if we do break higher, we've got 99.57, which is a very long-term low. If I pull it back from when summer 2023, you can see there corresponds with a minor fib level as well of last year's high to low at 99.51. If we do roll over, then I guess, yeah, 98 is decent support. Before then, obviously, these long-term lows and that long-term trend line just above 97. Okay, let's wrap it up with cable, and we do get UK GDP data out on Thursday. Output should rebound really after October's fall, but then the bigger picture really is there has been a slowdown in UK growth through the second half of 2025. Potentially a seasonal issue. Over the last few years, we have seen better growth first half, then worse growth second half. But certainly a lot of this weaker growth could be down to the budget, November budget, if you remember, and a lot of uncertainty really sort of hit fragile consumer confidence and really put off big investment and spending decisions. So for sterling, interesting, we found support at the black line. This is cable, so sterling against the dollar. Black line's the 200-day moving average, so that's a 133.86 there. You've got that high, this year's high actually at 135.67. So interesting level there. And then you can see some fib levels as well. If I just pull this out. So you've got the halfway point as well, which acted as support. That is from the high in July down to the low in November of last year. So halfway points at 133.97, so just above that 200-day moving average, but decent support there. And then the 61.8 is at 134.88. Okay, a bit longer than I thought. Obviously, a lot going on. Really hope again that has been of use to you guys. Really do appreciate you, as always, being on the call. Please do follow us on social media as well. If I just pull up the social media channels for Vantage. Here they are. And as I say, we do put out a daily commentary as well on the website after the US close. Again, lots going on. Really interesting for us. Geopolitics is amongst obviously data points as well. Yeah. Thanks again for being with us, and we will speak to you the same time next week. We will do that, and just bear with me 1 second because I've got a question actually, which is good. Bear with me 1 second. Just a question asking, can we still upload market insights in YouTube? Market insights, I guess you mean the market commentary, or do you mean this recording? I'll double check with the guys who do that, and yeah, just check market insight. So the commentary I mean is essentially okay, the recording. Yeah, let me check that. Thanks for the clarification. I'll make sure that if it's not on YouTube, then I'll check why it's not, or hopefully it will be going forward as well. So the recording of this webinar. Great. Thanks so much for the question, of course. Always do appreciate any feedback as well. And as I say, we'll speak to you same time next week. Take care.